Welcome to the Retirement Daily Learning Center on the Street. Our topic today is an introduction to charitable giving. And our speaker is John Nersesian. John is head of advisor education at PIMCO. In that role, he provides advanced wealth management and investment consulting education to financial professionals. So welcome to the webinar, John.
Thanks, Bob. It's great to be here.
Great to have you here. We're looking forward to it.
Fantastic. It's a good time for this conversation. As you and I were chatting about, it's November, and this concept of charitable giving, I think, is on people's minds at this particular moment in time.
It is, and we're looking forward to a deep dive into the subject.
Okay, great. Let's jump in. Let's talk a little bit about charitable giving. Let's talk a little bit about how to make the giving that we're doing more effective. So once again, not about giving away more money. Bob and I are not here to solicit donations for our favorite nonprofits. We're here to educate about how charitable giving works and how to make that giving even more impactful for yourselves as donors and for the receiving organizations that are important to you and your families. So we'll talk a little bit about what's going on in the world of philanthropy, and then we'll try to make this very practical in terms of talking about what should I give, who should I give to, when is the best time for me to give, and then more importantly, or maybe most effectively, how do I give with maximum impact? And so it is important for us as individuals to make sure that we're giving correctly. We think about financial management and the great relationship that we may have with a financial advisor and the kind of very important financial counsel that we get. But charitable giving, Bob, for some reason is often overlooked. We spend a lot of time and energy thinking about, is our portfolio properly allocated, which is important? Is our retirement plan, effective or compelling for our retirement goals? But something that is often overlooked in this planning process, either by individuals or advisors, is, once again, this concept of how do I integrate charitable giving into my overall financial landscape? And so we'll try to help solve for some of that gap that exists. Hey, money is being given to charity, or I should say charitable gifts, because sometimes it's not money. It includes property, and we'll get into those differences shortly. Charitable giving reached an all-time high last year, Bob. Now, I can't make a promise as to what the numbers are going to look like in 2022, as we've gone through a lot of market volatility and a decline. But as you can see from the chart before you, charitable giving in 2021 was exceptional here in the United States. People felt compelled to help those that are less fortunate. Maybe COVID-19 pulled on our heartstrings a little bit to try to support those who needed some help. And maybe even the tax code itself inspired or motivated people to give more money or to give more of their resources, because charitable giving remains one of the few itemized deductions in the revised tax code. And we'll get into that in greater detail in a moment or two. These are the top recipients. It's probably not surprising. Religious organizations, whether it's our church or our synagogue or any other religious organization that we're affiliated, they're the number one recipient. Education services or providers is number two. And then human services, which includes hunger, which includes disaster relief, which includes homelessness. That's the third most popular recipient of our charitable giving. The question is, why are people giving? And the answers are obviously very personal, but I thought that this might be interesting to see what motivates one to give. Take a look at the fifth item on the list, Bob. The fifth item on the list is the tax benefit. I always assumed that it was the tax advantage that was the primary motivator. Okay, if I write a check to charity or I give property, I get a corresponding deduction. So the gift is providing not only the charity with a benefit, but I get one as well. But interestingly enough, and I think this is kind of impressive, people are giving for reasons other than the tax benefit. 40% of those who give say, wait a minute, the tax benefit really wasn't the key motivator. There were other things that were more important to me that my charitable giving achieved for me or for my family. Number one, do I believe in the mission or the organization itself? Is it one where there's maybe some personal relevance? If I had a family member that was affected by cancer, that organization, of course, is going to provide some more personal meaning. Number two is the idea that my giving actually makes a difference, maybe to the organization or maybe to the recipients or the beneficiaries of that particular organization. And then maybe here's one of the things that I think is very motivating to some, including myself, is it makes me feel good. You and I know this because we volunteer a lot of time and energy in a variety of different things. And it's funny, I got involved in these kinds of activities previously thinking I was giving of myself to others. But when you do that, you wind up getting back so much more yourself. So it's kind of a two-way street, so to speak. And that's a key motivator for many who are giving. Let's talk a little bit about what you might give. The easiest is cash, right? It's easy. When I say cash, I don't mean dollar bills necessarily, but writing a check or swiping a credit card. And Bob, you've probably seen this too, that, I get solicited or introduced to charitable opportunities from friends, and they'll send me a link to the website. And in some instances, that's the only way in which I can give. They ask me to fill out my credit card information and fill out an amount and hit send. And so that is a very convenient way to give. Car expenses. For those of you who work for an employer that pay you 58 cents and change per mile, you're not going to get that here. If you happen to spend your time and energy to drive or to use car expenses for some charitable organization that you're supporting, maybe you're volunteering and giving out food this Thanksgiving in a couple of days, and you're driving, you're going to get a 14-cent per mile deduction for the mileage that you've incurred in that process. A lot of people give household items. It's the end of the year. I mentioned to you, Bob, that my wife and I are probably downsizing our home here in Wilmette. And what we will probably wind up doing, in fact, I know we will be doing, she's been on this project for a while, is giving things away to nonprofit organizations that either then turn around and give them to recipients, or sometimes they sell the property and use the cash for charitable purposes. And then giving of vehicles has become popular in recent years. It's a more substantial gift, and it provides a convenience factor, of course, as opposed to selling my car, selling my boat, selling my airplane, if I had one. And I don't. Let's talk about the more complex assets and what they are. And then we'll talk a little bit later about the advantage in some instances of giving this type of property as opposed to the convenience of writing a check or swiping a credit card. Giving appreciated assets makes a lot of sense, Bob, because in doing so, I can avoid the capital gain that is attached to that vehicle. And we'll get into that in greater detail. So it's stocks and bonds and mutual funds. And I can give these vehicles directly to the receiving charity, or I can use a conduit instrument like a donor advised fund or community foundation as a way of facilitating that gift of property, but doing so in a more convenient fashion. I didn't mention it on the slide, but in addition to that, I can also name a charity as the recipient of my life insurance policy, which is another investment or financial vehicle that can provide an intended benefit to a certain charity. I can give collectibles, the Arshil Gorky painting that's hanging in my living. I can give that to my favorite charity, but I got to be careful. If I give a piece of artwork, for example, to an art institute, the deduction that I receive is more valuable than if I took that artwork and gave it to a non-affiliated type of entity, like the Red Cross hypothetically, or the Cancer Society. They refer to this as same-use recipient charities. And the deduction that is available to the individual is greater when we're giving items like collectibles to a same-use type of charity. Retirement assets, I can use a QCD, and we're once again to find that in greater detail, to give today while I'm alive, once I'm over the age of 70 and a half. I can use this methodology to distribute from my retirement account directly to a charity. I can even name the charity as the beneficiary upon my death to receive those assets at that point in time. All right, what's not a gift? Maybe this is just as important as those items that we just defined. I've got bad news for friends. That raffle ticket that you buy hoping to win, the lottery or your charitable organizations fundraising, you don't get a deduction for that raffle because there's a potential personal benefit that you derive from it. You can't deduct your time. And so if I'm going to spend time supporting a nonprofit organization, it's appreciated and it's well-intended and it makes me feel great, but there's no corresponding deduction for the amount of time that I'm spending. And then for many of our friends with us today, maybe they buy a ticket for a dinner, or they host a table at their favorite nonprofit organization's fundraiser. The check or the contribution you make directly to the charity is a deduction, but you don't get a deduction for the table that you've purchased or the meal that you've consumed. Those, of course, have a personal benefit and therefore are non-deductible. Hey, let's make sure that we're clear on this deduction that I constantly refer to. And we'll define two characteristics. Number one, what kind of property am I giving away? And number two, who is the recipient? Now, we broadly define the recipient as either a public charity or a private foundation. Public charities encompass most receiving organizations that you and I are familiar with. So it's the American Red Cross and it's our local church. It even includes structured vehicles like the Schwab or Fidelity donor advised funds. Those are all examples of public charities, and most giving is done through that manner. Private foundations really reserved for the certain very small percentage of the giving community. It's for families that maybe want to make a very substantial gift of $5 million or more, want to become involved in running these organizations and all the legal fees and administrative costs. So it's a much narrower universe of individuals who might consider the private foundation. And for that reason, I want to turn our attention and really focus on the public charity. If I give cash, I get a full fair market value deduction of the amount that I'm giving, but there's a cap on how much I can take in any given year. This does not reduce my deduction, Bob. I get the full value of what I'm giving. That limitation of 60% that I'm referencing refers to how much I can deduct in a single calendar year. So let's say that my adjusted gross income for the year is $100,000. The maximum deduction that I can take by giving this property would be worth $60,000. So if I give $50,000 to the charity, good news, I get the full deduction of the 50 because it's below the 60% cap. If, however, I've given $75,000 to this particular charity in this year, I'm going to get the full $75,000 deduction. I only get to use $60,000 this year based on that AGI cap. The remaining $15,000 gets carried forward for up to 5 years for me to continue to utilize. You can see the different caps or limitations on different types of property. I would strongly recommend giving long-term property is very valuable. I get the fair market value deduction of that appreciated Keysight stock or Apple shares or Fidelity ETF. I can give that property away. I get the full fair market value deduction, and I avoid the capital gain in doing so. But there's one asset I would encourage our friends not to give. And once again, I appreciate their generosity. Don't give away property at a loss. So I bought a stock at $100,000. It's trading for $50,000 today. If I give the $50,000 stock to my charity, I get a deduction of $50,000. I'd be better served selling the stock, booking the loss for my personal tax benefit, and then giving maybe the resulting proceeds or giving another property that provided a greater advantage. Does that make sense?
Yeah, it does. 100%.
Yeah. Okay. All right. So we talked about this idea, Bob, of giving away property, appreciated property as opposed to cash. And I wanted to provide a very quick illustration of how that works and maybe more importantly, the benefits that are derived in doing so. So let's assume that our friends have an asset worth $100,000. And the good news is they bought it a number of years ago for $20,000. So there's an $80,000 embedded gain that has not yet been realized. Let's take a look on the left in green, and let's find out what happens if this client or this individual, once again, has property that they're buying and selling throughout the year and then is giving to charity, but is doing so in a disconnected fashion. In that instance, the client has the property worth 100, the cost basis is 20, the gain that they realize by selling it is $80,000, and it's taxed at the maximum long-term capital gain rate of 23.8%. That individual will pay $19,000 in taxes. They would then give the remaining $81,000 to charity, and for their charitable gift, they get a deduction for it, which is worth at a 37% bracket, about $30,000. Let's now shift to the right-hand side of the slide. Let's assume that this individual says, wait a minute, I've got capital gains that I'm realizing during the year and charitable gifts that I'm making. Let me pull this together. Let me do so in a coordinated fashion for a better outcome. So the client in this particular instance has a $100,000 capital asset with the same $20,000 cost basis. There's no gain because they're not selling it. They're giving the property to charity. The charitable contribution is $100,000. The deduction is worth $37,000. Take a look at the bottom of the slide. By giving in this manner, the same type of property, the charity wound up with an incremental $19,000. The donor wound up with an incremental $7,000 tax deduction. And so this is why we often hear or are advised that while giving cash is great and it's very convenient and the gifts are, fulfilling and appreciated, sometimes giving property can produce greater economic advantages. All right, who do we give to? Number one, identify organizations where your values align. I think that's a key thing. What are the values of your family? What's meaningful in your life? Maybe that should be the key motivator in terms of, the charitable gifts that we give, because we want to perpetuate organizations or charitable causes that have provided us with a personal experience that is somewhat relevant. Maybe it's better for me to define the organizations that are not qualified charities, just in case there's confusion. I belong to a couple of golf clubs, one up in Evanston, Illinois, and one down in Naples, Florida. And boy, I would love to get a charitable contribution for the support I provide when they decide to redo the 18 greens. That is not a charitable organization. Political contributions are non-charitable. And I see confusion on that one. Oh, I'm going to support my favorite candidate who's running for Senate or for mayor or for president. That does not receive a charitable contribution, as well as any other sort of commercial enterprise, chamber of commerce or civic leagues. Those kinds of organizations do not qualify for a charitable contribution.
Yeah. John, let me ask you,
Yeah.
Let me just interrupt for a second. When you think about qualified organizations, oftentimes people are maybe familiar with the term 501c3.
Yeah.
Is that the only one, or are there others that you would
Yeah, 501c3s are certainly where we should devote our energy and attention, because 501c3s are those that have been designated as charitable organizations. Now, some organizations haven't been designated as such, and so you've got to test the waters to determine whether or not they would qualify as a charitable organization. But most larger established organizations have gone through the process with a tax ID number to register as a 501c3. My church has done it. Many of the public charities that we give to, they're all registered as 501c3s. If you have any concern as to whether or not that organization, that receiving organization, is a qualifying charity, take a look at GuideStar. GuideStar.org is a fantastic website that gives a listing of those identified charities that have registered as such, the total amount of their assets that are being managed, the distributions that have been made, and, which I think is really compelling, the percentage of contributions that they receive that are actually given out as donations or as supporting gifts, as opposed to the administrative costs that you and I would like to avoid. We want to give to charities that are using our gifts in the most productive or efficient manner. Make sense?
Yep, perfect. Yeah.
Cool.
Thanks for elaborating on that.
Sure. Let's talk about when to give. But before we talk about, when I should give or when my giving is most beneficial, let's do a quick little review of the tax structure here to set the table. So we know that here in the US on the federal system, we've got a progressive tax structure, right? It starts at 10% and it maxes out at 37% at $650,000. And Bob, I think these are 2022 numbers. They're changing in 2023. I think given the high inflation that we've experienced this year, those brackets are going to go up rather materially. I guess that's the good news. Inflation's been a real burden to many of us based on our cost of living. The good news is these brackets will go up by about 7% next year. So you won't hit that 37% marginal tax bracket until your income is 7% higher than the 650 number shown here. Many of our friends know that there's a second federal tax system in place called the AMT. Now, very few people are subject to it, but I do want to illustrate an important difference. The regular code, if I'm subject to it, maxes at 37. The AMT code, if I'm subject to it, maxes at 28. So while the charitable gift that I make is deductible under both tax regimes, the tax deduction I receive when I'm subject to the regular code at 37 is more valuable to me than if I happen to be in the AMT in a given year, where my benefit only saves me 28 cents on the dollar. We've talked about deductions, and I do want to remind everybody that this concept of the deduction, there are fewer of them around today. Charitable giving, of course, is one of them. So the charitable gift that I make is one of only 4 common tax deductions under Schedule A. There used to be a lot more, but they were significantly reduced under the Tax Cut and Jobs Act that was instituted in 2018. Good news, the standard deduction is much higher today. And therefore, more and more taxpayers are not going through the complexity of itemizing their deductions. They're just taking the higher standard number of 25.9. The itemized deductions include the following 4. Medical expenses, but they've got to exceed 7.5% of AGI. Salt taxes are deductible, but I have bad news, Bob. Living in Massachusetts, or I'm here in Illinois, or our friends in California or New York who are maybe paying significant amounts of state and local taxes, they're capped at $10,000, as I'm sure many of us know. Mortgage interest is still an itemized deduction, but only if I'm itemizing. And then finally, charitable gifts are one of the 4 more popular or useful charitable deductions in the year in which I make that contribution. So let's think about that. Given the tax regime that we've just identified, assuming that I have some flexibility as to when I'm going to give, when do I derive the greatest benefit from the giving that I'm doing? Well, here are some broad suggestions. Number 1, when you're claiming the itemized deduction, if I'm taking the standard deduction and I'm not itemizing, that charitable gift does not provide a deduction or a tax benefit to me. Now, you may remember, Bob, that in 2020 and 2021, there was a shift in the tax code, a temporary opportunity to give up to $600 per couple. Even if you weren't itemizing, you got what we call an above-the-line deduction for the $600 that you might have been giving to a certain charity. That's gone starting in 2022. So an individual must be itemizing in order to receive a deduction for the charitable giving that they're doing. Number 2, I want to give when I'm subject to the regular code at 37 versus when I'm at 28% in AMT. That may be obvious. Thirdly, I want to give if I'm a closely held business owner and I've got significant income. I'm going to use my charitable giving as a very effective way to lower my income, because the qualified business income deduction available to all pass-through entities like limited liability companies and partnerships and S corporations, really significant deduction that's available to those closely held business owners. But for many of them, there's an AGI cap at which they lose that very valuable deduction. So maybe I give to charity in a year to lower my income and to retain the QBI deduction for that closely held business owner. And then maybe, obviously, my giving provides the greatest benefit to me when my marginal rate is higher. If I've just started working and my income $70,000 a year, my marginal bracket is lower. If I'm older and more experienced and in a higher earning income year in my life or stage in my life, the charitable giving that I'm doing is going to provide a greater tax advantage. So if I'm going to retire, Bob, in 2 years, maybe I accelerate my charitable giving now while my income is high before my income will decline in my retirement years, hypothetically. Maybe I give when I have significant capital gains as a way of offsetting some of the tax burden that is born from the sale of property that produced a large capital gain for me in a given year. Maybe, and I know, given your retirement expertise, this is something that you can speak to, better than I ever could, the concept of Roth conversions. We all know that the Roth, of course, provides a significant advantage for certain individuals. I do the conversion today. I pay the taxes, but the good news is the money then grows tax-free and is not subject to RMDs. The one caveat, Bob, is when I do that conversion, I've got to pay the tax in the year of conversion, although maybe there's an opportunity to do it today, given the depressed values in our retirement portfolios, to do that conversion now at a lower tax cost. The point I'm making is, if I time the two together, I make my charitable gift in this year, in the same year in which I'm making my Roth conversion, maybe the two corresponding issues offset each other. And then finally, for those who are corporate executives or working at publicly traded companies, we know that we report income on our stock options when they're exercised and our restricted shares when they vest. And so that's income that we have to report. and maybe I use my charitable giving to lower the income from those events. All right. Let's talk about when we give. And I love this slide. You know that.
This is a great slide, John.
I don't know. Maybe our friends on the line won't think it's so great, but we'll hear from them, I guess, if it's not. I like it because it adds value. It educates us, and it guides us to achieve a better outcome through some very simple planning or guidance. So let me set up the stage and illustrate what's on this slide. This is an individual who decides to support their favorite charity, and they reactively give, every year as they're asked for a contribution, $25,000 a year. And that client gives either property or writes a check or however they give. And I'm not even too concerned as to who they're giving to, but it's a qualifying charity. And they give, what the terminology I'll use is they give reactively based on when they're asked, as opposed to intentionally to time their gifts and what they're giving in a more proactive approach. So at the top, Bob, we can see this individual who has $10,000 of deductions. Okay, that's their state and local tax. This individual doesn't have a mortgage. And every year they give $25,000 to their favorite charity. Their itemized deductions in these 4 years, each year, is $35,000 a year. We know that the standard deduction is $25,900. Based on the charitable giving that they're doing, it's pushing them just above that threshold. So they're going to claim the larger amount. They're going to claim the $35,000 each and every year as an itemized deduction to offset or provide a tax benefit. That total deduction over the 4-year cycle, Bob, is $140,000. Let's go down to the bottom of the slide. Let's look at the green illustration. This individual has given the same amount, Bob. It's the same $100,000 that went to their favorite charity. But what this individual did, and I suspect you've heard this term before, is they chose to bunch their deductions to give more to their donor advised fund or to contribute more to their donor advised fund. Now, from that fund, they can give any amount they want to their charities whenever they want. So the recipient organization can get the money, or we can make the distribution at any point in time. But the point is that my personal deduction is determined based on when I either give the property to charity or I contribute to my donor advised fund. So this individual in 2022 has $10,000 of income and property taxes. That's the cap, but makes a charitable contribution in that year of $50,000, either directly or to their donor advised fund. The total itemized deductions in that year are $60,000. That far exceeds the $25,900 standard number. And so they're going to claim the $60,000. The next year, this individual, because they gave more or funded more into their donor advised fund, the year before gives nothing. They have itemized deductions of only $10,000. They're going to claim, though, the full $25,900. They're utilizing more of the standard deduction in the second year because they're not making an itemized deduction. And you can see that they repeat this same methodology, Bob, in 2024 and 2025. The same total amount, $100,000 given in the top, $100,000 given in the second or bottom scenario. This individual receives an incremental benefit of $31,800 by giving the same $100,000 to either their donor advised fund or to their favorite charity, whatever they gave. Now, the benefit's probably even greater, Bob. This may somewhat understate the benefit because in theory, maybe I'm giving appreciated property as opposed to writing a check, and I avoid the capital gain and the associated tax benefit. And by the way, the money, the value of that account in the charitable organization, that money grows tax-free, as opposed to keeping it in my own name, paying taxes on the growth, and then giving away the same amount. And so there's an incremental benefit that we derive above and beyond the $31,800 that's illustrated on this slide.
Well, what's interesting, John, about this slide is for individuals who may not be familiar with this technique of bunching, this is really helpful for our advisors who are watching this. If they're not talking with their clients about the possibility or opportunity of bunching, this is could be a lost opportunity for them.
Yeah, it's a great way, Bob, and thank you for mentioning that. I often refer to the tremendous value that an advisor provides their client, right? What we call delivering alpha. So what is my alpha as a financial advisor? Okay, so the investment activities, maybe I can help clients achieve better outcomes by better allocating their portfolios. But planning-based decisions, like the one right before us, is a perfect illustration of how an advisor, in some of those functions that we had identified on that really cool graph at the beginning of our discussion through the charitable giving and the retirement advice and the family governance and the estate planning and all those other factors or functions, they also improve our client outcome in addition to the investment guidance that we're providing as well. So good point. All right, let's talk about how you give. And we'll start with the simple stuff and then maybe spend a little bit of time on the more complex structures that may or may not be appropriate for a large percentage of the people who are with us today. You can see that we kind of graph this or lay this out based on complexity or convenience. The most convenient or most simplistic ways to give are on the far left. And then we kind of move up this continuum to the far right. And so we talk about some direct gifts, some philanthropic or charitable structures that serve as intermediaries or conduits for our charitable giving. We talk about split interest vehicles, and then finally the private foundation opportunity, which once again has a very limited applicability to certain types of families. So direct gifts are obviously a convenient way to give. I give currency or cash or credit card, including online. I can even give personal property, the clothing that we run down to the Goodwill or other receiving organization at the end of the year. That's a way of emptying our closets. That's that's the primary motivator for my wife and I, and also, maybe doing good for the receiving organization. And you get an immediate tax deduction. Now, you've got to, if you're giving property, of course, you got to discount the value of the item appropriately. If I'm giving cash, it's the full fair market value of the cash or credit card or check amount that I'm giving. I do need a corresponding receipt. I don't have to turn it in when I file my taxes, but I need to have it if I'm claiming the itemized charitable deduction on my tax return. I've got to have evidence of it to support my charitable claim if and when I need to do so. Another direct gift opportunity for certain individuals, those who are lucky enough to be over the age of 70 and a half, can give directly, but not from their checking account, Bob. They're going to give from their retirement account. So you and I both know that once I reach the age of 72, and you'll notice the disconnect in the ages here because of a recent change under Secure, I'm required to take RMDs at age 72. Who knows? Maybe that number goes to 75, Secure 2.0. We'll wait and see. But that's the age at which I must start taking distributions. And as you know, when I take distributions from my retirement account, either my 401ks or my IRAs, I report the income. Now, I may be giving to charity in that year by writing a check or swiping a credit card or by giving property to a charity. And depending on my tax circumstance, I may or may not be deducting it. I can achieve a better outcome. I get the opportunity under a QCD to give up to $100,000 per year. It's got to go directly from my IRA to the receiving organization. I can't take possession or receipt of the funds first. It's a direct distribution. The cap is $100,000 a year. It counts or qualifies as part of satisfying my RMD, but I don't report the income. I don't suffer the increase in my AGI, which has negative consequences on the taxation of my Social Security and my Medicare premiums and may push me into a higher marginal bracket. So this is a very effective way for those individuals, once again, over the age of 70 and a half, those who are required to take RMDs, those who want to make a charitable contribution to a receiving organization. It's a great way to put the two together and to achieve a better outcome.
So, John, before you move on, two questions. One is for folks who may have a 401k and they're 70 and a half. They too can use the QCD from their 401k or not?
They'd have to do a rollover and then from their IRA make that QCD contribution.
Right.
And once again, they've please notice on the slide too, SEPs and some self-employed individuals have a SEP as opposed to a traditional IRA or opposed to a traditional 401k. SEPs and simples are not eligible. So once again, it's got to come out of the IRA.
Right. And the same would be true for a solo 401k, I would assume.
Yeah, the solo 401k, which some individuals use as a way of, socking away some more dollars for the self-employed type of individual. Yeah, good observations. Now, some people say, wait a minute, John, maybe I can do this and I can distribute from my IRA and I can put that money into the donor advised fund that I had established with Fidelity 2 years ago. Now, unfortunately, it doesn't work that way. If you're going to use the QCD opportunity, the money's got to go directly to a qualifying 501c3. It can't go into that intermediate vehicle. It can't go to you. It's got to go directly to the receiving organization. It works really well, Bob, for the individual who's not itemizing. The individual who's, once again, taking a taxable distribution from their retirement account as they're required to at age 72, but giving money to charity, but not getting an itemized deduction. This is a way to derive the same benefit from that, even if they're not itemizing.
Right. And to me, one of the more interesting things about this opportunity is oftentimes we say that it may be used to satisfy some or all of your RMD, but because RMDs start at 72 now, you have this window between 70 and a half and 72 where you don't have an RMD, but you can still use the QCD.
Yeah, you can. So that's kind of a quirk, if you will, right? Because we know that RMDs used to start at 70 and a half. They now start at 72, but the QCD opportunity still retained the 70 and a half age limit. So individuals could certainly use it then. It's maybe even more compelling to use it in a year in which I'm forced to take a distribution. Stop and think about this, Bob. A lot of the retirees that you and I speak to, they're taking RMDs from their retirement account, even though they would probably prefer not to. John, I've got this vehicle that allows me to grow and compound wealth on a tax-deferred basis. I'm not using the money. I've got other resources, but RMDs force me to take it.
Yeah.
And maybe for that obvious reason, that's why Roths obviously are not part of this discussion for the QCD.
Yeah, I'd say one of the more frequent questions we get is, I have to take the RMD, but I don't need it for my living expenses. What do I do with it?
What's your answer?
Well, QCD is one of them. That's for sure.
There you go. That's where we were going. Yeah, the QCD works. Or got to take the distribution, pay the taxes. Maybe you offset it with a deduction in another form or fashion. But you're right. It is the challenge for many. I love this idea that we are extending the RMD age, because stop and think about it, Bob. When the tax code was written, and I don't have the exact numbers, longevity expectations were, 75 years old. Today, we're living longer. So I'm going to need that retirement money to cover a longer period of time or a longer, a greater age in my retirement lifestyle. So the idea that I can maybe delay that and allow that money to continue to compound and to have more resources available for the later stages of my life, that kind of makes sense to me. Mm-hmm. All right, let's talk about donor advised funds. And this is, I think, going to be very relevant for the folks who are listening in with us today. Donor advised funds have become really a great way to achieve many of the significant benefits that a private foundation, those more complicated vehicles, they provide significant benefits, but the donor advised fund is philanthropy on training wheels. It makes charitable giving more effective, and it makes it more convenient. And you can see the growth in donor advised funds, how it's rather substantial. The average account size is almost $160,000. And you can see the number of accounts and the amount that is contributed and the values of these accounts have grown substantially over the past couple of years. Donor advised funds facilitate that term that we used earlier, Bob, of bunching my deductions. So once again, I make a contribution to my donor advised fund of $100,000, but then I can distribute from it to my favorite charities in any amounts at any point in time. So even though the deduction is bunched or timed for maximum benefit, the receiving organizations that I give to, I have full control. And now you've got to look into the donor advised fund that you might be considering. What's the minimum contribution amount that I can make to establish one? What is the menu of investment options once I make that contribution? What kind of property are they capable of receiving? Is it limited to just public securities and cash? Or can I give a piece of real estate or interest in a closely held business as a way of financing my contribution? And then what is the minimum distribution or the methodology required as to how I then start distributing from this Powell or Nersesian family foundation that I've created through the convenience of a donor advised fund? It's a pretty cool way for us to be charitable with our intentions and to receive a lot of the benefits associated with more complex vehicles in a pretty convenient manner.
Yeah. You mentioned, John, Family Foundation as part of the DAF, and I often think that when people create a DAF, it's a great way to involve their children in their charitable decisions in terms of who to give to and why.
Yeah, I love that reference, Bob. We run a workshop on family governance and family wealth responsibility and education. And one of the things that we often talk about, in addition to other best practices, is using philanthropy as a way of a family establishing their values and then conveying them to that next generation. So when my wife and I set up our donor advised fund in 2008, gosh, 14 years ago, our kids at the time, I think, were maybe 6 and 10. And so we got them involved. We sat around the kitchen table and asked them, what do you think about this idea? And how much should we put in? And then regularly, on a regular basis, we got them involved in the distribution process. After the account was funded, who are we going to give the money to? And tell us about the kinds of organizations or individuals or nonprofits that you've heard about or that you've learned about that are meaningful to you. It is a great way. Kids don't listen, Bob, to what we tell them. Kids learn from what they observe in our own behaviors. And so if you've got a family or parents who are charitable and empathetic towards others, our children are going to observe that behavior and they're going to probably replicate it themselves. And so charitable giving is a great way to extend the benefit to the idea of family governance or responsibility in that next generation. Community foundations. I live in Naples. The Harry Chapin Food Bank is the largest one down there. They do great, fantastic work. They run fundraisers every so often to fill their coffers. And then they are an intermediate or conduit vehicle then to make distributions to support a specific charitable purpose in a particular or localized community, such as literacy or homelessness, or in this case, hunger. Most of the donations, by the way, come from the public, as opposed to a single family that's making a very substantial contribution to the community foundation. Charitable remainder trusts are an example of a split interest vehicle. Time doesn't permit us the opportunity to get into it now, but a CRT is a split interest vehicle where I make a contribution, I receive an income stream from that trust, and then my named beneficiary or charity receives that principal at the end of the term, either a specified period of time or the end of my life. And so there's kind of a dual benefit, hence the name split interest vehicle. A charitable remainder trust. I receive a deduction on the property I contribute. I avoid the capital gain. I get an income stream, but the charity receives the remainderment at the end of the trust. A CLT works in opposite fashion. It's also split interest, but instead of me receiving the income, the charity receives the income. And then my beneficiaries receive the remainderment at the end of the term. So this works particularly well if I want to endow a scholarship program, or I want to finance the operational expenses of a building that I want to support. So in this particular instance, once again, I get the deduction when I make the contribution. I avoid the capital gain if I'm putting in appreciated property. The charity receives the distribution from the trust on an annualized basis, but then my family receives the remainderment at the end of the term. And then we talked about private foundations, but I would suggest that given the complexity, given the cost, given the availability of now a donor advised fund, which provides many similar benefits, this is really suitable only under unique circumstances. A client who wants to make a significant charitable gift of maybe $5 million or more, they're willing to pay the administrative expenses to establish it and then to manage it or maintain it. Maybe the attractiveness is getting the children or the family directly involved on the board to receive grant requests and then to vet them and make distributions from that family foundation. So in those unique circumstances, a private foundation may make sense, but for many others, it's the other vehicles that we've discussed that can accomplish a lot of the same objectives. Let's talk about some questions. So I begin to think about, all right, John, you've motivated me to think a little bit more about the charitable giving that I'm doing. How do I think about this issue with the help of maybe my financial advisor? How do I decide how much money I give every year? Is there a budget, a charitable budget that I've established? What do I donate? Am I giving the property that I should be giving? Am I writing a check or swiping a credit card? Am I giving appreciated property? What is the best way for me to fund the charitable giving that my family's currently doing? Am I receiving an itemized deduction, or am I falling into the camp that many are where I'm claiming the standard deduction? And how does that affect the timing of my giving or the amount of my giving? What motivates me to give? Well, what are the reasons? Is it the tax benefit? Is it the opportunity to help others who are maybe less fortunate? Is it the personal satisfaction that I derive knowing that I'm doing something good for others through the charitable giving that I'm involved with. And to your point, Bob, take a look further down the list. How do your children view your giving, and have you gotten them involved in that process? And could this be a great way for us to facilitate that conversation, that learning curve that we'd love? But Bob, there are a number of attributes: entitled, unmotivated, lack of gratitude. None of us want to raise children with those attributes. We'd all love to raise children, regardless of our financial success, that are grounded, that are appreciative, that are humble, that are giving, that are empathetic. And so maybe this conversation or this process of charitable giving can help us with that objective in mind. A couple of resources that may be beneficial. Giving USA Today. That's a fantastic publication that comes out. I think it's just about the middle of every year. I think they publish in June or July. And I love reading their report about all the trends in charitable giving, and I can learn a lot from that, and a couple of other resources that we've mentioned as well.
John, this has been a fantastic webinar. I'm sure it will generate questions on the part of our viewers and listeners. If you don't mind, I'll encourage them to write to us, and maybe we can answer questions that they might have based on what they've learned today.
Yeah. Do we need to give them an email address, or what do you? I'm happy to share mine if you want me to, or direct the inquiries any way you want to you directly, or whatever you think is best.
Yeah, I think what we'll do is encourage them to email me, and I don't want to have them overestimate their ability to tap into your knowledge at each and every turn. So
there's only a little bit there that's available.
So we'll encourage them to write to me at rpowell@allthingsretirement.com.
Love it.
And then I'll forward questions that are appropriate to you. So, but in the meanwhile, thank you ever so much. We're so grateful for you to join us and give us that introduction.
My pleasure. I hope it was helpful. I hope we covered the salient issues that affect most of the people who joined us today, gave you a little bit of a primer. Two things: mechanically, how does charitable giving work? And then maybe in a slightly different context, inspire us to think about intentionally what type of philanthropic activities we want to be involved with. So thank you for the opportunity.